I'm going to talk about demand system asset pricing. And so what I thought would be useful is to just first give you like a one slide of like what can you do with the demand system. Then sort of like defining a little bit better what we mean with demand system asset pricing and also kind of what it's not, to just be very precise about what we have in mind. I'll give you sort of a couple of examples then in sort of more detail as to why I think sort of like modeling the asset demand system and having a realistic model of the asset demand system is really important for not just asset pricing, also for corporate finance and macro, and sort of see why I think it's sort of important to confront that issue. I'll sort of give a bit of an overview of like what we know, what we don't know, where the open issues are. And then I want to sort of like show you that, kind of like it's a bit of a coincidence, to be honest. One aspect that's going to be really important if you think about modeling asset demand is to understand which assets and which investors are kind of similar to each other. And it turns out that a lot of the tools and the techniques that have been developed in AI recently are actually sort of like very useful for modeling the asset demand system. So I want to sort of show you some of our recent work on what we call asset embeddings, and actually some new work we're doing that we haven't put out yet and see sort of broader applications of that methodology. And then, as I mentioned, sort of like throughout, I'm going to sort of like highlight like sort of open questions that we're sort of like thinking about, potential directions for future research. And I just want to emphasize throughout is that there's still a lot of stuff that we're like figuring out. And so think of this as really as kind of like a work in progress. What I'm going to talk about today is based on joint work with so the team is Modo Yogo, Rob Richmond at NYU, Modo at Princeton, and Xavier Gebex at Harvard. Okay. Given that it's kind of a longer session, so if you have any questions at any point or something is unclear, then just like raise your hand. That may be sort of easiest. Otherwise, we can leave some questions, time for questions at the end. Okay. So what can you do with the demand system? So I think broadly speaking, there we go. Broadly speaking, sort of in the context of asset pricing, there's like four things where I think sort of demand systems are going to be useful. First is to explain and understand, and I'll be much more precise about that later, movements and moments, so think of betas, volatilities, and so on, of asset prices, including like stock market, bond markets, like currency markets. And in particular, sort of like tracing it back to different investors or groups of investors. Or if you want to think about it in a more international context, like which countries or geographies matter for fluctuations in prices. Okay? The second is that quite often, and again, I'm going to get back to this in more detail later, is that we're interested in counterfactuals. Like what is the impact of like QE, change in regulation of banks and insurance companies, the growth in like ESG demand on asset prices. And so in order to answer those questions, you need to have a well-specified demand system. Now, then it turns out, and that's kind of like where some of the recent literature is going, is that you can start using these models for out-of-sample prediction. And so you can think about it for predicting like asset prices. You can think about it predicting like flows and demand for certain like groups of assets. I'm going to show you based on some of the new work we're doing is that these methods, in particular in fixed income markets, are actually very useful to predict like ratings, downgrades, volatility, and yields. And so you can really start thinking about credit markets as well. And so that's another like set of applications of demand systems. And then lastly, sort of like there's a broad literature going back to the mid 80s actually on trying to estimate like slopes of demand curves. And the demand system like is essentially doing this for like all assets, for all securities. And so it goes beyond sort of like things like index effects or the effect of QE, and you really have to think about like what are the slopes of demand curves for lots of assets. Okay? And so for all of these, you need to have a model of the demand system. Now, backing up a little bit, let me first define what we mean with like demand system asset pricing, or at least what Modo and I had in mind when we started this. So any model, okay, that you write down, any sort of like asset pricing model starts from like preferences, technology, beliefs, and constraints. And then there's sort of two things that come out of that. One is you're going to get a model of the stochastic discount factor, and then we sort of like estimate these models and test them based on the fact that they have to price all the assets. Okay, so that's like the vast majority of asset pricing. Now that same model, and that's something I want to emphasize, the exact same model, okay, always implies also an asset demand system. Okay, what does that mean? It's going to give you a demand curve for like every investor. Investors are being indexed by I. That demand curve depends on prices and something that moves your demand around. So something why you like certain assets, why you like certain asset classes. Okay, so maybe because of like the stock's growth rate, maybe because of its profitability, riskiness, and stuff like that. All of that goes into the demand shifter new over there. Okay, and then asset prices come out of like market clearing is that the sum of demand across all investors has to be equal to whatever has been issued by firms. Okay? So same model, two implications, and it just happens to be the case that like most of the literature has focused on the implications of the model in terms of its pricing ability. Okay? So to understand sort of like, can we generate differences in expected returns? Can we sort of like get enough predictability and things like that? Okay? And so we want to sort of like start thinking about the second part as well. And so, as I mentioned, sort of most work focuses on sort of like the joint sort of like understanding of prices and fundamentals. And then more recently, there's also this like sort of important literature using like survey data on beliefs and to see whether that sort of like helps like models with like subjective beliefs, whether those help to explain asset prices. So I'll get back to this literature later on and how it connects to, demand system asset pricing. Okay? So, same model, sort of two sets of predictions, and we're going to focus on the second one. Okay? And so what demand system asset pricing is and what it's not is that like it's really like think of it as like models and empirical frameworks to jointly understand asset prices, fundamentals, beliefs, and then also like the holdings and portfolio flows. Okay? And so it's really emphasizing the testable implications of those models for prices and the quantity data. So it's really bringing like P and Q together. Now, the way I would sort of like characterize is that it's kind of a new approach to asset pricing in the sense that it's sort of like it's taking those other implications like more seriously and see whether the models align with the data along that dimension. It's not a new theory per se. Okay? So, as I mentioned before, like any model is going to imply both like a demand system and a stochastic discount factor, and so you can test sort of both sets of implications of the model. Of course, it may be true, as I'm going to sort of like discuss later on, that sort of there's like insights that emerge from like testing the models along those dimensions, which then prompts you to write down different models and sort of like update sort of existing theories. Okay? But the important thing is that it's not a new theory like per se. Like, I don't know, in that sense, like, all of asset pricing has a demand system sort of like going on in the background. Now, it also does not assume sort of like once you sort of like go along with that one, it also sort of like does not assume that there have to be frictions or institutions or segmented markets, frictional markets, things like that. Like none of that sort of like is required. A perfectly integrated, like very, very elastic model, like the CAPM. It also implies a demand system. And then really the right question to ask, sort of like from our perspective, is like, well, is the resulting demand system that comes out of that model, is that a good description of like investor behavior? Okay, so that's sort of the main idea. Okay, so now that we sort of like understand what a demand system is, like why is it important to sort of test this particular dimension? Because of course models are being rejected along all kinds of dimensions. So why is this dimension so relevant, we think? The reason is that a lot of the key questions that we're interested in, those tend to be sort of like quantity questions. Okay, what do I mean by that is that we're very often interested in questions where we're shifting the demand from one group of investors, and then we're trying to understand what is the impact on asset prices and ultimately like the real economy. Okay, so for instance, if you think about the work on capital regulation of banks and insurance companies, then we're trying to understand, well, what is the impact of that on asset prices? And actually, this is precisely the reason why Modo and I started working on this kind of like line of work, is because Modo and I were working on sort of the insurance sector, and we were arguing that there seems to be more risk in the insurance sector than sort of typically believed. And so then the question was like, well, what would happen if a large insurance company fails, given that insurance companies are the largest investor in corporate bond markets? And so then we needed to sort of like figure out, well, if you get a big shift in the demand for corporate bonds, what is the impact on prices? And we sort of like realized that we didn't have like great sort of like frameworks to think about that question, and that's really what prompted us to start thinking about that. Okay, and so demand systems is really sort of like getting the demand system right is essential to answer that question. Second, if you think about sort of like quantitative easing and tightening, it's really a demand shift now, not from institutions, but from central banks. And then you can think about what is the impact on fixed income markets. You can think about sort of the growth in ESG investing. You can think about the growth in passive investing on asset prices and market efficiency, or sort of in a global context, what is the impact of foreign flows on the decline in interest rates and convenience yields. Okay, so one part of this is sort of like think of these sets of questions as there's a demand shift by like one group of investors, and we're trying to map out what is the impact on asset prices and whatever depends on those asset prices. Okay. There's another way of viewing why this could be relevant is that there's a way what the demand system gives you is that it's going to allow you, and I'll be more precise about this later, it's going to allow you to trace movements in asset prices back to particular sort of like groups of investors. And that could be useful if we want to sort of get questions to like very like long-standing questions, like why sort of like prices move in the way that they do. Maybe it is useful to sort of like start mapping this to different groups of investors that may be sort of the primary driver in those fluctuations of prices. So just to give you like a couple of examples, okay, based on some of the work we've done, so you have like concrete examples. So for instance, if you look in the cross-section of stocks, prices tend to move too much relative to fundamentals, building on the work by Campbell and Schiller for the time series. And so now you can trace it back, like how important are different types of investors, how important are retail investors, how important are institutional investors, and so on. Similarly, like there's a lot of questions that we have about sort of like these like market themes that seem to generate like enormous swings in prices. For instance, you can think about like the meme stocks, like the Magnificent Seven, ESG stocks, and so on. And we're trying to understand like why sort of like can you get prices to move as much as they do. And so here you can trace it back again to different groups of investors. And again, that may help you to try to understand why prices move as much. Together with Xavier, we thought about sort of like how can you understand the volatility of the aggregate stock market, and can you trace that back to different groups? Thinking about sort of like movements in exchange rates or like the strength of the dollar, you can trace it back to the demand for like assets coming from different countries, and maybe that's sort of a useful way of thinking about the world. And then of course there's like I know Jeff's work on like once sort of like anomalies have been documented, we see this like big drop off, and also a very nice recent paper by Andrew Chen and collaborators. And so normally then we think, well, there's some arbitrage capital sort of like moving around, and that's why you sort of see that those anomalies get competed away. Well, how much capital is moving around, and which investors are sort of like competing those anomalies away? And do we see that if those investors are more or less present in certain anomalies, that those anomalies are more or less powerful out of sample or work less well out of sample? Okay, and so it's really sort of like, it's really sort of putting sort of the quantity side together with the prices and say like, okay, if we're gonna sort of think about sort of different mechanisms that explain why prices move, then starting to think about heterogeneity may be sort of useful, and then the demand system is again a critical way of sort of connecting prices to quantities. Yeah.
So Rob, my question is related to this point. Don't you need some kind of linear score crunch? For main shock like can affect prices based on this. What you have is correct stuff. Usually there's that has that linear smartphones. Otherwise,
yeah,
just the main shocks.
Yeah, so you're one slide ahead of me. So one critical thing in terms of like getting answers to these questions is to get the demand system right. So like all I'm trying to say here is that in order to get the right answers to these questions, we need to have a well-specified demand system. You're also right to say that if demand is like very elastic, if investors are like really responsive to like small movements in prices, then what would happen is that a lot of these answers are pretty boring. A lot of these questions are very boring answers, like, well, not that much. Okay? But then we do, on the flip side, we do see like very large fluctuations in markets. Okay? Now, if you want to sort of view that through the lens of these very elastic sort of models, then what that implies is that demand shocks are almost perfectly correlated. So it means if you see meme stocks move a lot, okay, that must mean that, for instance, like all investors have those same beliefs, or they're up against constraints very quickly, and then they can't contribute, and then you get into sort of like things like segmentation and frictions. And so now the alternative view of the world, where I'm going to go next, is say, well, maybe that perfectly elastic model is not a good way of summarizing the demand system or modeling the demand system, and we may need something else. And then what sort of like is the microfoundation of that something else? And that's where limits to arbitrage, frictions, and so on may come in. Okay? But so the way I want to think about this part so far is that to get answers to these questions, you need to have a well-specified demand system. We still have, I think, sort of like important questions about sort of like, why prices move in the way that they do. And then sort of like in the context, if you view that through the lens of the perfectly elastic markets, you get a very clear answer. That sharp answer is that like lots of demand shocks are essentially perfectly correlated. Okay, now we can look at the data and sort of say, is it true that sort of like that's what's really going on in the holdings data? Make sense? Okay, thank you. Okay, so one key input, sort of like as we just talked about, is this sort of like demand elasticity. Okay, and so what is that? It's sort of like how much do I move, sort of like the amount of like a particular asset or an asset class that I hold, if prices move around. And what is kind of important here is that the all else equal. It's sort of like I don't change my view about expected growth rates. I don't change my view about riskiness. I don't change my view about any of those things. But like prices move for some reason. Okay, now sort of like how aggressively do I trade on that? Now, in standard asset pricing models, like demand is like very elastic. Okay, investors are like really reactive. Like if you think about the standard CAPM, so orders of magnitude is that at the individual stock level, the micro elasticity, as we call it, is around 250. So what that means is that prices move 1%, your portfolio will move by 250%. Okay, so one way that I know many of you have experienced this is that if you solve like a mean variance problem, okay, without any constraints, your portfolio weights go like all over the place, and small changes in inputs lead to like very sort of reactive portfolios. Now that is also true, sort of like if you think about sort of like estimating that parameter. So it's really that sort of like elasticity that is driving that. Now for the aggregate market, it's still very elastic. Okay, so the elasticity is around 20. Now, if you want to sort of like translate this into another parameter that may be more intuitive, is that the inverse of this one is the multiplier. So the way to think about that is that an elasticity of 20 for the aggregate stock market means that, let's say the Norwegian Sovereign Wealth Fund owns 10% of the US stock market. If they were to liquidate the 10% of like the entire US stock market, the implication would be that prices would move by just 50 basis points. Okay, so it would be like absolutely tiny effect, sort of like to your point. Okay, and so that's just an implication of these models. This is true in rational models and behavioral models alike. So this is not sort of like the purely rational model. This is a much broader statement. Okay, now there's of course like a long literature on this issue, and so on measuring sort of these elasticities. And so this is a paper from a figure from our paper with Xavier. And so what we try to do is to sort of like go across like different methodologies. It goes across different countries, and you can do this even across different asset classes, but this is plainly for equities. And so what you see is that you can use like index inclusion, people look at mutual fund flows, trade execution, cash payments coming from dividends, and use that as instruments, using sort of like factor exposures, other like demand systems like our work with Modo, international evidence. And what you find sort of like across the board is that these elasticities are like way lower than even the macro elasticity. And in most of our models, the macro elasticity is like way below the micro elasticity. Okay, and so you should compare these numbers to like 250. Okay, and so you see that those are way below. Okay, and so the first order sort of takeaway is that if you start looking at holdings data, is that you're going to find that portfolios are not very reactive. And if you want to have like sort of two facts in your mind, if you open up holdings data that you're trying to explain, it's sort of the following. First is that investors hold very heterogeneous portfolios. Okay, so the median investor holds fewer than like 100 stocks and deviates from the market quite a bit. Okay, so fact number one is you hold very different portfolios. You may say like, well, that's consistent with people having very different beliefs. But then sort of like all the investment opportunities move around. So take your favorite model of like expected returns. So characteristics move around, prices move around, and people barely trade. And so that sort of like implies that, okay, you start with like completely different sort of like views on investment opportunities. And then from then onwards, they're kind of like perfectly correlated. Okay. And that's sort of like the basic fact that if you start estimating these models, you pretty quickly run into the fact that like a lot of these investors seem to be inelastic. Okay. Now, so that's sort of the big picture takeaway. Now, that doesn't mean that sort of like this is kind of like a closed chapter, like far from that. So there's a lot of empirical questions still how to best identify those elasticities. So even though there's like lots of different methodologies here, okay, you can quibble with each one instrument, okay? And so as kind of like always, so what you're going to find is that different instruments, they give you like slightly different elasticity. So some papers may find an elasticity of like half, some may find an elasticity of like 4. Now you may say like, oh, one is like, let's say 8 times larger than the other one. That's kind of like missing the bigger picture point that we're quibbling about sort of like these differences versus like where theories are. Okay. And so like once we sort of get like down to this over here, then these smaller differences matter, but we first need like models that actually are consistent with something in this range, I think. Okay. So oops. Okay, so first is that these different instruments, you still see differences. You see, I don't know, naturally differences in estimates, and we need to understand, like, what are the identifying assumptions? Which one are more plausible? Why would some, let's say, the exclusion restriction be violated for one instrument, but would it be more plausible for another? In some cases, like the power of some of the instruments is pretty borderline in terms of like the weak instruments literature. And so then, like, what often happens is you need to start pooling across different periods, and maybe that's a strong assumption. That's something that we need to figure out. Second is that sort of like in theoretical models, like what really matters for these demand shocks is how persistent they are and to what extent they are anticipated. So one very nice paper by Sam Hartzmark and David Salomon is using anticipated dividend payments. In a lot of the models that we write down where markets are more inelastic, these anticipated shocks would do nothing because markets are still sufficiently forward-looking that those demand shocks shouldn't sort of generate large price effects, yet they find that they do. Okay, so that's sort of like a question as to how to think about those. But sort of importantly is that sort of I think for the empirical work it would be very helpful is that whenever like people report like demand shocks is that we figure out, well, how persistent are they, to what extent are those anticipated, and so on. Okay, and then the next question is like, how do these elasticities vary across firms and how do they vary across time? So over time, I think the broad conclusion in the literature is that elasticities tend to drop in bad times. Okay, so markets are more inelastic during downturns. Okay, and demand curves are more downward sloping. Price impact is higher. Across firms, though, there are some like surprising facts. First fact is that it seems that elasticities are lower for large firms, which means that sort of like price impact is larger if you measure it as a fraction of like market cap that you buy. Okay, but of course all the liquidity measures go the opposite direction. Like we always, I don't know, think of small firms as being more illiquid. Okay, but now the question is if you scale it not relative to volume but relative to like a firm's market cap, it seems that in some recent papers that elasticity is sort of the opposite, goes in the opposite direction. Now, one way to think about it economically could be that maybe for the large firms there's like more benchmarking going on, so you have to hold Apple and you have to hold it relatively close to market cap, and maybe that's why there's like less elasticity there. But that's something to sort of like explore like with different instruments and so on to see is like how robust are these findings. Okay. And so I think that there's sort of like a lot of interesting questions to explore and like, first of all, like, I know what are these, elasticities and how do they move across time and firms? And then sort of on the theoretical side, I think the big picture question is like, why are these elasticities so low? Okay. So if we go along with this like large empirical literature, then what are good models, to get at these lower elasticities? And it's really a very primitive question in terms of like, well, what's a good model of portfolio choice? If we want to describe what investors are actually doing, then what is a good way of thinking about their portfolio choice problem and so on? Now we have lots of mechanisms, qualitative mechanisms that slow down elasticities. Okay. So for instance, if you have to learn about sort of what the investment opportunities are, then pretty quickly you get much lower elasticity. So there's a pretty nice paper by Carter Davis. And what he does is he takes all the machine learning, sort of like the recent machine learning papers, computes the implied portfolio rule and asks like, well, how aggressive are those like portfolio rules trading? And you may think that, well, those are very sophisticated sort of methods. What you find is that the elasticity is actually not very high that comes out of that. Okay. And these methods sort of like obviously understand it as like noise. There's lots of regularization going on. And so maybe it's enough to start thinking about sort of like learning, private information and so on. But then the real question, if we want to be like sort of like serious about those theories, it would be very nice is to sort of like put them to the same sort of quantitative tests as we've done before with lots of other models and ask like, well, like how much private information does there need to be? Like how uncertain do investors have to be about like risk and expected return and other motives that drive trade? What kind of frictions are like really important that limit sort of like their behavior? And I think sort of like what would be really valuable is to make this like much more quantitative. We have massive amounts of holdings data and sort of get a sense of like, okay, like what can really sort of explain the portfolios that we observe, like both in the cross section and also over time as new information comes in. Okay. Okay. So then sort of like, if we want to go to sort of like data, we need to have a mapping between like theory and sort of like an empirical model that we can estimate. And so what Modo and I did sort of in our 2019 paper is to provide sort of like some assumptions under which you get a very sort of tractable model that depends where demand depends on prices and characteristics. So I'm going to use that model now to explain sort of like some insights from that. But that's not to say that that's sort of like that you can't sort of generalize it in very sort of like important ways, and I'll talk about that after I sort of like laid out this model, because I think it's sort of like useful to broaden the perspective a bit. So, but to get going, sort of like what we're going to assume is that returns follow a factor model, and two, that expected returns and factor loadings, that those depend on characteristics. Okay, and that's something we commonly assume when you sort stocks into portfolios. Then we think that once those stocks are grouped into different buckets, then their expected returns and factor loadings are more similar. Okay, so if you make those assumptions, okay, then you're going to get a relatively tractable demand system that I'm going to show you on the next slide. Now, the point to emphasize though is that this is just one set of micro foundations. There's actually a lot of other models that give you the exact same estimating equation. So for instance, if you add hedging demands with the additional assumption that the covariance between sort of like the portfolio return and whatever your background risk is or whatever investment opportunities that you're trying to hedge, again, if those covariances are a function of like characteristics, you're going to get exactly the same estimating equation. If you think about Kyle 89, where you have private information and imperfect competition, same estimating equation. If you have differences in beliefs, some models of constraints, or if you have like direct preferences for, let's say, green stocks, same estimating equation. Now, of course, what is going to be important is that the connection between those estimated coefficients and the deep parameters of the model, those will change. Okay, and so for counterfactuals and so on, we do care about the micro foundation. I'll get back to that later. But if you just care about estimating sort of slopes of demand curves, there's a very large class of models that's going to lead to essentially the same estimating equation. Okay. Okay. So what does that model look like? So it turns out that you get something that is quite tractable as a logit style model. So the notation here is that theta I80. So this is the fraction of my portfolio of investor I that I'm going to invest in asset A in quarter T. And it has this logit structure over here where you see these deltas. And the delta, think of that as like the relative attractiveness of stock A in my portfolio. So take the log over here, so that's exponentiated. So then it depends on price, it depends on how expensive a stock is, like all else equal. So that's the beta 0 over here is going to control the demand elasticity. So 1 minus beta 0, roughly speaking, is the demand elasticity. Then you have other characteristics over here, and those characteristics capture my factor loadings and expected and other things that go into my expected returns. But if you think about a model where you have demand for green stocks, it would also go into the XAT. And then you have the last component over here that we refer to as latent demand is everything that's unobserved to us as the econometrician. And so later on, once we start talking about sort of like making the connection to like AI methods, this one is going to be very, very important. Okay. And so what you get out of this is a relatively like tractable model that has a very simple estimating equation, namely that if you take the log of the portfolio holding over here of a particular stock relative to the fraction you put in the outside asset, think of that as cash. Okay. Then you just get sort of this linear model. Okay. Now there's one concern that you have to deal with is that there is this endogeneity problem that sort of like valuations over here are going to be correlated with latent demand. And so we need an instrument. And so this whole discussion on demand elasticities is really about how do you instrument for prices over here so that the instrument is correlated with prices, but it's uncorrelated with latent demand. Okay. And so that's sort of the key equation that we are estimating. Okay. Now, you may wonder, like, where do all the other prices and characteristics go? Because if you think about sort of like standard sort of portfolio choice, it's really like the price of a particular asset relative to like all the other options that you have. And that gets encoded over here in the sum. Okay, so all the information about other investment opportunities gets encoded in a single constant. So that's one sort of like nice feature of the characteristics-based model, mean variance model, is that everything gets summarized just in that one term. Okay. Now, it also sort of shows that this model may be quite restrictive, and you may want to generalize it, and we're going to talk about that in a minute. Okay? So, first, one comment is that over here, we are taking logs. The reason we do that is that if you just look at the holdings data, then portfolio holdings are like very skewed. Okay. And so it's clearly closer to log normal than normal. And that is just a direct property you pretty much inherit from the size distribution of firms. And so doing things in logs makes a lot more sense. Second is that, like so far, the model is just looking at long positions, primarily because we don't have data on short positions. But sort of like recent data has become available where you can use data on shorting at the institutional level. And so it'd be really interesting to sort of like also model the short side. So technically there's no problem with having long and a short side. And Federico Monardi, a job market candidate, who's going to be in the market this year, has an earlier paper where he sort of like works out what the implications are of that, and what the relevance is of adding a shorting sector. But then if you combine it with like the recent data that, for instance, Stacia uses in her job market paper, I think you can do a very good job also covering the short side that we didn't do so far. A third sort of like extension that I think is worth exploring is the importance of the extensive margin. So later on, I'll show you sort of like how important different like elements of the model are to explain return variation. The extensive margin plays a non-trivial role. We keep that fixed in sort of like what we've done so far. But the median investor, as I mentioned before, only holds like 100 stocks. And so understanding sort of like how do you choose those stocks, to what extent you have flexibility on that, I think is worthwhile to explore in more detail. Now also sort of the model that I showed you so far and the model that we've estimated is a static model. It's just a 2-period model. In the paper with Xavier, there's an appendix where we have a dynamic model also for the cross-section of stocks. Okay, and so now you need to start thinking about sort of like how you do identification in that model. But in principle, then you can start thinking about how investors like gradually change their portfolios over time. There may be some inertia and things like that. And then it may be helpful to sort of start thinking about the whole panel dynamics of portfolio holdings. Okay, and so if you're interested in dynamics, in principle, sort of like the theory is there, estimation still to be done. But conceptually it can be done quite easily. Okay, so those are like some extensions that I think are interesting. Now, how can you then do counterfactuals in such a model? So we've written down a model of portfolio choice so far, and so now we're going to bring in market clearing. So what do we have is that this is the total market cap of like firm A. We're going to sum across all the investors. This is the wealth. AIT is the assets under management or wealth of an investor. And then this is the fraction that they're going to put into a particular stock A. Okay, so you have a whole system of those equations. And what we saw before is that this portfolio weight over here depends on the valuation of that stock, its characteristics, the preference that an investor has for those characteristics. I like profitable firms, or I like firms that do R&D. And then we have latent demand. And so this is like a big fixed point problem that you're trying to solve. Turns out that it's a relatively simple algorithm that converges like really quickly. You can just like run it on your laptop in like, I don't know, a minute. To solve for like prices if you do counterfactual sort of experiments. So for instance, you could ask, well, suppose that one group of investors over here gets an inflow of assets. What is the impact on prices? If you want to then like recompute sort of like asset prices, essentially you're solving for this fixed point where you're expressing sort of the valuation of a particular firm, depending on the wealth distribution across institutions, depending on the characteristics, taste for those characteristics, and latent demand. Okay, and so that can be done very easily. Now, what you can then also do, and I'm going to show you some of that in a minute, is that because you sort of like start from like all the investors and add them up to get to the market clearing prices, is you can start to think about, well, how much of the change in prices from one period to the next is driven by particular groups of investors. And of those investors, how much is coming from the fact that some get in or outflows, that there's some change in their preference for characteristics. So kind of gradually over time, let's say starting since 2015, some investors like green stocks more than they used to. There could be like shifts in latent demand. And so we can start sort of like tracing back sort of like the movements in prices over here between one period and the next to anything sort of that goes into the demand system, anything that sort of like you see here on the right hand side. And then again, that's really just an accounting identity, and that's something that you then want models to match once we have confidence in that we've estimated the demand system correctly. Okay, so here's like one such calculation that we did in our 2019 paper to make it a bit more tangible. And so what we're asking is sort of like in the cross-section of stock returns, okay, what is driving the variation? So for the first part over here, what we refer to as supply, think of that as XAT moving. So it's sort of like the stock characteristics, there's a component of dividend yield, and then there's firms like issuing more shares and buying back shares. And so it's a variance decomposition. So if you sum up everything over here, it adds up to like 100%. And so what you see is that if you're trying to explain sort of like movements in prices with characteristics, then you don't get very far. Now, we used a fairly small set of characteristics motivated by the 5-factor Fama and French model. Since then, others have sort of extended this to like the whole, factor zoo. And it seems that you can sort of increase this a little bit to something like 20-25%, but surprisingly hard to get a very high link between sort of change in fundamentals and stock returns. And so then what is sort of like happening on the demand side? So assets under management is relatively small component because like the fundamentals are not that important. The taste for those fundamentals, also the beta ITs moving around, also doesn't explain that much, around 5%. And so what you're left with is an important role for latent demand. And so what you get is that about like a quarter of the variation is being traced back to movements in latent demand on the extensive margin, and more than half is due to change in latent demand on the intensive margin. So it's the epsilon IT. Okay, so it's the epsilon IT moving around over here. And that's really important to explain changes in portfolios and to explain stock returns. Okay. Now, one interpretation could have been is that this is all just sort of like idiosyncratic like stuff at the stock level that's hard to capture. Later on, once we get sort of like to the AI part, essentially what we're doing over there, if you want to connect them, is that essentially we're going to impose structure on latent demand and ask, is there some structure we can learn from latent demand where there's sort of like characteristics that investors care about that, but we don't have easily sort of like in, let's say, CRISP and CompuStat. Can we learn from latent demand what those characteristics are? Okay, so that's where that's connected. Okay, and what this is telling you is that that's not a small part of return variation, it's not a small part of portfolio variation. So regress like your holdings on characteristics and you're going to get a very low R-squared, relatively low R-squared. Okay? And so there's a lot of information in there, we think, and that's what we're going to exploit. Okay, so this tells you sort of like how you can do these variance decompositions. Now there's a broader question about like running counterfactuals and sort of like under which conditions can and can you not do that. Okay? And so that really gets to the whole conversation on like what about the Lucas critique? Okay? And so first of all, like what's important to emphasize is that in our work, sort of like we always sort of like start from like a particular micro foundation that gives rise to the demand system. So we make assumptions on the technology, on the endowment process, on the preferences and beliefs, such that the demand system that we get out of that is consistent with that micro foundation. So under that model, okay, the counterfactuals are correct. More importantly, and this is sort of drawing a bit of a distinction between sort of the inference part and the counterfactuals, is that what I also showed you before is that there's lots of different ways of microfounding the exact same estimating equation. So if you're interested in estimating plainly demand elasticities, then even if we have the wrong microfoundation, but we're still within this broader class, the demand elasticities are still sort of like correctly sort of like interpreted, but of course the mapping to the structural parameters would not be. Okay? Now then there's a broader question, which is kind of an interesting one, is sort of like in general, okay, is that if you have misspecification, okay, then of course, you're going to get sort of like invalid sort of like counterfactuals. But it's not sort of like that's only true sort of like in the context of demand systems. That's just broadly true. So you can start with like a perfectly like microfounded model, but if you then start to do counterfactuals and the model is misspecified, then of course your counterfactuals would not be very informative either. So on the next slide, I'll talk about a potential solution to that, or a way to sort of make it sort of a constructive discussion. But I think what it does sort of like highlight is that if we want to start using these models for counterfactuals, and of course thinking hard about the microfoundations is going to be really important. And in particular, we need to start thinking about models that sort of can generate sort of this inelastic demand, because that is a feature that holds much more broadly. Okay? Okay, so So what are sort of like potential directions to explore building on this? Okay, and so I'm going to give you sort of a couple of directions that we think are interesting. So one is that there's a very sort of like productive literature trying to sort of like understand whether models of subjective beliefs, for instance, like using fading memory by like Stefan Nagel and Zhu, or work on, let's say, diagnostic expectations, whether those are sort of like helpful in explaining fluctuations in asset prices. Okay? And so typically the way these models are now being tested is by connecting sort of like survey data on beliefs, to asset prices. But of course, if you write down the full model, then what really happens is that some investors must have those beliefs. Okay? And that's what informs their asset demand. And that's why it sort of like shifts prices. And so again, sort of like by going through the demand system, we can sort of test the mechanism of these models at a more granular level. And so, for instance, we can start asking questions like what fraction of investors has diagnostic expectations, or what fraction of investors has fading memory? Are these like fractions stable over time, or do you see, for instance, after like long periods of like, let's say, rallying technology stocks, that sort of these fractions are changing over time? And sort of like importantly is, to what extent are the current models of beliefs able to explain a large fraction of latent demand? Okay, so one way to think about it is that you can just start by like the micro foundation of the beliefs, work out what the asset demand looks like, feed in the actual data of like what investors see in terms of like past returns and past fundamentals, see how their portfolios change, and sort of like how well are these models able sort of to explain at the same time prices and portfolio holdings. And it may well be the case that the data call for much richer dynamics in terms of like how investors form beliefs. Okay, but it's a very rich sort of like testing ground for these models, because like there's a direct implication of how the belief models are going to have implications for portfolios, so that ultimately they can affect asset prices. Okay. Okay, second sort of like connection to make is between sort of like demand system asset pricing and corporate finance, or macro more broadly. So one assumption that we sort of maintain throughout is that the expectation of latent demand conditional on the characteristics XAT is 0. Okay? And think of that as kind of like an endowment economy. So given the endowment, you're going to figure out what are prices. But the characteristics, they include things like earnings, they include payout policy, leverage, and so some of these are obviously controlled by the firm. And so you could imagine now sort of like taking the next step and sort of adding like firms to the model, and sort of ask the question, well, suppose that firms can choose like maybe a subset of these XAs, and you just like sort of like combine it with your standard like Q theory model. Now you can sort of like think about explaining at the same time so the holdings of investors, asset prices, characteristics, and the decisions that firms are taking, which essentially would be equivalent to making it closer to like a production-based asset pricing model. Okay, and so there's some sort of like work going in this direction. Now, the aspect that becomes particularly useful is that what really matters over here is sort of like what is the impact of a change in characteristics on valuations. Okay, and in the demand system, what that is going to be, or what it's going to depend on, is the beta on that characteristic weighted by who actually owns that stock. And if there's heterogeneity in how much, let's say, investors care about leverage, or how much investors care about receiving dividends, let's say in a low rate environment, if that sort of preference changes, then that's going to change the incentives of the firm. Okay, and so you can start thinking about how to sort of connect these together. Okay, and so that we think sort of like could be a productive way to start connecting asset pricing and corporate finance, and again bringing just a lot more data to understand firms' decision. Okay, and then the last one, which is something that we've been thinking about a lot recently, is sort of like how do you test and compare different models? And it turns out that also in IO, this is actually not a very well sort of answered question. It's my understanding. So here's the sort of the issue is that sort of like we see lots of like new models sort of come up, and oftentimes those models are not necessarily nested. So you can have like different sort of structures of the demand system, and one is not a strict subset of the other. And so how are you going to evaluate sort of these different sort of like non-nested models of demand? And so similarly, suppose that let's start from the idea that like all models are going to be incorrect. They're going to be slightly misspecified. We still need answers to some of these counterfactuals. Like how we're going to evaluate sort of like different models that we want to use for counterfactuals. And so it seems natural to us to start using these models like for out-of-sample analysis. So define a set of like policy changes that we want the model to be able to explain, then feed those in out of sample and see how well the model is able to sort of like predict like movements in prices and things like that. Okay, so just to give you like a concrete example, you can think sort of like before like a QE program starts, okay, you estimate your demand system, you feed in the purchases by the central bank or the announcement, and now you ask, is the model able to sort of like explain movements in yields, movements in exchange rates, movements in stock markets, and so on and so forth. Okay, and so starting to evaluate these models out of sample, we think is going to be quite useful in discriminating between different models that all are going to be slightly misspecified or more misspecified. In the context of asset embeddings, I'm going to sort of give you some examples. One simple way of seeing how you can use these models out of sample is to see whether you can use it for return predictability. And so what Modo and I did in our earlier paper is to take the following logic, and that is that what we saw before is that what the demand system implies is a mapping from like valuations or stock prices to like the wealth distribution across investors, fundamentals, preference for fundamentals, and latent demand. Now what that means is that if I can predict any of these inputs over here, okay, so if I can predict flows across institutions, predict fundamentals or the taste for fundamentals, if I can predict there's going to be more ESG investors in the future, or if I can predict latent demand, then it would allow me to predict sort of prices in the future, and therefore I can predict returns. Okay? And so we did a very, very simple version of this in our earlier paper. And what you see is that if you use that predictor of prices and therefore get a measure of expected returns, then that works quite well, in particular for smaller stocks, to predict returns above and beyond like lots of other characteristics that we know. Okay, and we think of this really just as a proof of concept, because we did something that was like really, really simple, namely saying that if latent demand now is positive, that means that investors really like it, then in the long run, that's going to mean revert to zero. And that was a way of how we formed expected returns. So we didn't sort of like try very hard to sort of think about, well, what would be the best model for each of those components, and can we use some of the insights from the recent machine learning literature to forecast all of these components, impose market clearing, and then use that to forecast returns. Okay, but that seems to us like a very sort of interesting and natural direction to explore. And now you're using lots and lots of holdings data also to start thinking about return forecasting and to see whether these models are useful for out of sample predictability. Yeah. Okay. Okay. Yes.
When you think about like momentum in that regression, but as prices are mostly depending on latent demand over the last year, like,
yeah,
do you think, is there like interoperability between latent demand, like maybe past latent demand predicting future latent demand?
Yeah. No, so for sure. So you're absolutely right. That's sort of like it has like the one that is like most closely connected is actually value. Because like if you have high latent demand, you're going to have like high valuation. So that's kind of a growthy firm. And so essentially like what it's saying is not so much that these are like uncorrelated, at all. But like the way we would ideally want to go is to sort of say like, okay, can we understand each of these characteristics that have a price in them? So can we understand sort of like what drives value or what drives momentum if you have a dynamic demand system? And then to sort of see like, okay, what is the underlying sort of like, what are the primitive shocks to like, I know, the betas, fundamentals, and latent demand that give rise to the momentum signal, and then ultimately to like why momentum predicts future returns. Okay. And I think you're exactly right that if you want to start thinking about momentum, you kind of like inherently have to think about the dynamics of the demand system. Okay. Okay. So now let me sort of like transition a little bit. And so far it was just about like what is demand system asset pricing, what can you do with this, and hopefully it gives you a bit of a perspective on why it could be useful. Now one thing that sort of like jumped out at us is that you see that there is this very important role for latent demand. And so the question is like, what is this latent demand really capturing? And that led to a somewhat broader question that I'll talk about now in the context of these embeddings. And that is that what's really important in the demand system is first get the elasticity with respect to price right, but more broadly sort of like what do investors consider to be similar assets and how do substitution patterns work? And so, for instance, like how do they sort of like compare Apple versus Google, or like a 9 and a 10-year Treasury bond, or like a 10-year Treasury bond and a 10-year like triple B bonds? Like, how do you capture similarity between different assets? And sort of a standard answer is that we're going to look at sort of like characteristics, but you quickly see like, how do I compare Apple to like a 10-year like triple B bond? Is kind of like complicated. Now, of course, our standard factor models and mean variance portfolio demand have like very clear answers to like all of those questions. But suppose we want to have like something that's empirically richer and that allows some deviations from that structure. Like, how do you measure similarity? Okay, and so as I said, the current model is going to rely on characteristics, but we saw before that there's like this big latent demand component. And so that means that like maybe characteristics just don't capture everything that's relevant to investors. Okay, maybe we just don't have the right set of characteristics. Yeah. In the counterfactuals, you mean? Oh, sorry. So what makes them similar? Right. Yeah. Yeah, so if you think about like a plain mean variance investor, you're going to sort of like get to the answer that two stocks are very similar if they have like similar, let's say, factor loadings or closely related to correlations. But now imagine that like I'm an ESG investor and I just want to hold green stocks. Then those stocks are similar to me as an investor, but not because they have the same risk properties, but because they have other properties that are making it an attractive asset for me as an investor. Or even more plainly, think about industries. Suppose I'm an I'm an index fund or a sector fund, and I can only sort of like invest in technology stocks. There may be another stock outside of the technology sector that's actually more correlated with the one that I'm holding within, but I'm kind of constrained because of some other characteristic. Okay, so there's a broader definition of like what can be like a similar stock. It could be similar in terms of like its risk properties, its growth rates, its like product market features, like if you think about the work by Holberg and Phillips and so on. Okay, so that's certainly one of it, but it's a bit broader than that. Thank you. Okay, so main point is going to be that we can actually make a pretty direct transition between some of the recent AI methods and how those can be used in the context of asset pricing. Okay, so in order to understand that, like we need to understand this concept of embeddings. And so embeddings are like really critical in modern like large language models. And what it really allows you to do is kind of like to do math with words. And so the simple way to understand embeddings is that we're going to represent some data, let's say a word, as a potentially like really high dimensional vector. So you're going to take a word, let's say apple, and you're going to map it to poof like a whole vector of numbers. And what that allows you to do is kind of the following calculations. Let's say you have like a vector for Paris, you subtract the vector for France, you add the vector for Spain, and out comes a vector, and that vector looks a lot like the vector that we had for the word Madrid. Okay? And so now once you have that mapping from like words to these embedding vectors, there's lots of things you can do with that, and you can use them sort of in all of these like modern models. Okay? But the starting point for all of them is an embedding model. Okay? For every model that we have. Now, what is the sort of like the main sort of like idea in terms of like how they figure out the mapping from the word to that vector is they're going to train it based on like massive amounts of data. Okay, and so they learn these representations, okay, from lots of data. Okay, and so the question is, can we do something similar in finance and economics? Okay, and so now it sort of comes back to your question. It's sort of like, okay, more broadly, so like asset demand systems is one application, but the idea is broader, I think, where in a lot of cases, whenever you use controls in any of your analysis, we're trying to essentially sort of figure out what are similar firms, and then one firm is affected by some intervention and another one is not. And so think about firms that may have similar growth rates, similar expected returns, risk, like asset substitution in a demand system, similar in terms of like product markets, and then the question is like, okay, how do you find these similar firms? Now, what we normally do is we use observed characteristics. Okay, and so you sort of say like, okay, there's two firms that are both in the technology sector, that are both large, they're both growing fast. Those are similar firms. Okay, now it's kind of easy to see that those characteristics are quite imperfect. So for instance, like if you look at standardized accounting data, then of course it gives you like a very useful summary, but it's incomplete. Like think about a company like Netflix that announces earnings, has good earnings, stock price goes down. Well, if you start reading the actual report, it says like, well, the number of subscribers of Netflix has been going down, and that may sort of like help you to think about what's going on with the firm. And so oftentimes we don't systematically collect that information, or it's not even available. Okay? Similarly, when you get into new economic environments, then oftentimes we need to sort of like very quickly figure out like what are new characteristics to measure exposure to that new factor. So we've just lived through that in certain like several variants. One is when the COVID pandemic happened, we quickly try to figure out like which firms are able to sort of like have a lot of their employees who like work from home, which ones have a lot of like face-to-face interactions. Think about the ongoing work now and how you measure like intangibles. How do you measure the impact of AI on different firms? And so whenever these kind of like big changes happen, then we sort of like try to find sort of like good characteristics to measure those exposures in creative ways. Okay? And so what we're going to sort of like explore is whether we can use these like asset embeddings as a way of capturing similarity. Okay? So then the question is like, well, which data are we going to use? Because like before, like the way it works in language models is that you use massive amounts of like text data. And so the first thing you may think about is like, well, why wouldn't we use text data? And you can totally do that. And I'm going to show you some comparison to text embeddings later on. Okay. But we're going to use other data, and you kind of like feel where this is heading. So kind of like in the same way as sort of documents are organizing words in sentences, and that's used to train these language models, or the way images organize pixels in like computer vision models. We have a lot of investors, both retail and institutional investors, that organize assets together in their portfolios, and that's going to tell us something about which assets are similar. Like if we're trying to figure out like how to think about like Tesla, do you think of it as like an AI company or like a car company or like a battery company? Then sort of like looking at like, let's say in which ETFs it actually ends up may be a useful way of measuring that. Okay. And so that's sort of the core idea. Now in the paper, what we show is that that's kind of a very simple theoretical result is that if you start from a standard like demand system like we saw before, and you substitute out prices, then you can sort of like recover all the information that's relevant to investors, all the characteristics, simply from inverting the asset demand system. So all the information is embedded in their portfolio holdings. And the only question then becomes like, well, what is the best method to sort of extract that information? But the sentence that we often sort of use is like that the econometrician knows less than the investor. In most models, that's only true if you do not get to see the holdings data. Even in models with private information, if you get to observe all the holdings, you can extract all the information in pretty much, most models that we know. Okay? And so theoretically, sort of there's like really good reasons to use holdings data and to see what we can learn from that. That is not at all to say that like sort of like characteristics are not useful or text data is not useful. Ultimately, we want to use all data we have to sort of like learn like what is a good way of representing a firm. We're just going to explore here, like, okay, what can we learn from text, from the holdings data, and then later on we get sort of thinking about bringing everything together. Okay, so then which method to use? So, if you look at the language literature, there's sort of like three big steps that they took. If you start in the early 90s, they had this method called latent semantic analysis, which is just principal components analysis, or those of you familiar with that are like recommender systems, like that have been used for like the Netflix price to predict like which movie you like based on other movies you've watched in the past. What's the analogy over here is that we're essentially trying to predict which other stocks that you hold given the other stocks you're holding in your portfolio. Okay, same logic. So then the language literature went beyond that and said like they started to estimate sort of like simpler sort of nonlinear models, so sort of like pretty shallow neural network models like GLOV and Word2Vec. But what those methods still have in common, both of these, is that there's a one-to-one mapping between a word and this embedding vector. Okay? And so context doesn't matter. And so the big breakthrough with the transformer models that really sort of like fueled the LLM sort of like breakthroughs is that you get these embeddings with context. So depending on like how the word is used in the remainder of the sentence, the other words in the sentence matter for how I interpret that particular word. And that's the same here. So there's like in our case is that if Tesla ends up together with like Ford, then sort of that may be sort of with GM, then it's going to be sort of like, I'm going to think of it as a car company. If it ends up with other companies that are more like in the battery space, I think of it as a battery company, or similarly, if it ends up with like Meta, Google, and so on, then I think of it as like an AI company. Okay. And so the way I think about a particular company sort of depends on its context as well. And so essentially now we're going to get a contextualized embedding. So the mapping between sort of like the company and this like vector depends on all the other stocks that I'm holding in my portfolio. Okay? And so what we're going to do is we're going to like look at all of these like 3 architectures and just sort of see like which method works for the questions that we're interested in. Okay? Now, how do you then sort of like learn these like vectors? Okay? And that is what we're going to do is we're going to use an insight again from the AI literature, and that is using so-called mass language modeling. So if you haven't seen this, this is how your LLM is trained, is that you're going to sort of like give it a sentence. Okay, so in this case, the movie is very boring. You're going to mask some words in that sentence. So you're going to mask a word like over here, and you're going to sort of like ask the model to predict what that missing word is. Okay, and in this case, using the transformer architecture, what you get out of it is once you go through the model is you're going to get like a whole vector of like probabilities that the missing word is like, I don't know, very fun, very scary, very boring, whatever. And so if you look at the top sort of like logits, the most likely words, then that is kind of like what goes in over here. Okay, now how do you sort of like move that to what we're doing? Is we're going to give it portfolios. So here you see, for instance, for like ARC, the ETF, the technology ETF, in 2022 Q4, these are the actual holdings. Okay, we're going to mask the 3rd position over here. The model is going to generate like what are like possible stocks that you could have had sort of like in that position. And then so the most likely one was Alphabet over here, and then you see over here the one that is highlighted, that's Tesla. That's the actual stock that they held in the 3rd position. And so essentially what it gives you is a ranking over like a couple of thousand stocks, and you're going to choose the parameters of the model such that it does a good job of like predicting what the missing stocks are that we sort of like artificially mask. Okay? Okay, so that's how the model is trained. Okay, now as a flip side to this, so I'm going to talk mostly about asset embeddings, but there's also like as a byproduct, you're going to get investor embeddings. What are those? Those are like vector representation of an investor. So if you take your holdings data and you like flip it, then you sort of like can estimate sort of like investor embeddings. And so now every investor becomes a vector, and you can compare which investors are similar. They're trading on the same themes. Okay? And so you can use it to classify investors beyond sort of like what we normally do, like size, institutional type, how active they are. And that's kind of useful because we find in a lot of our papers that it's really hard to explain heterogeneity and coefficients because we don't have like really good metrics of what investors do. You can use it to identify crowded trades. So now you're going to sort of like, first of all, the asset embeddings tell you sort of the common themes across investors. The investor embeddings tell you like who is trading on those themes and how aggressively. Okay, so that could be useful for that. And then you can use it to sort of like extend something that we've done sort of for a long time, is to use this for performance measurement. So you can build on sort of the classic work by Ken Daniel and co-authors, to not only do it by, let's say, size and book to market, but now you can sort of say, okay, here's 100 like managers that are similar in terms of embeddings, so they're similar in terms of trading styles, and how does the particular manager of interest compare relative to the 100 of investors that are similar, but now in a much more high-dimensional space. Okay? And so, main takeaway is that we think that these holdings-based embeddings are potentially useful to complement sort of what we have otherwise. Okay, so just to see this a bit in action, so here you see like 3 different investors. So the first one is dimensional large cap value. And so you ask, well, what are the investors that are closest to this after you've estimated the whole model, and see that it identifies like all of the value funds. You can do it for like, this is an exponential technology fund. What are the ones that are closest to that? You see like disruptive technology, innovative technology, and so on. Similarly here for like a biotech, like ETF, again, you see sort of like similar funds. One nice example is that we looked at another fund that is sort of like involved in special situations, which is a more particular thing that is harder to identify maybe. Again, if you look at some of the closest funds that it identifies, it's the ones that are involved in like merger arbitrage and things like that. And so we think there's a lot more that we can explore in this dimension, and it kind of comes as a byproduct after you've estimated the asset embeddings. Now then the question, and this goes back to the discussion on counterfactuals before, is like how we're going to evaluate like what is a good embedding model. And the reason why this becomes a relevant question, I think, is twofold. First of all, like if you look at the whole AI literature, like that literature was really propelled by the fact that they had like really good benchmarks to compare different models to. And so you see right now, whenever like a new model comes out from one of the AI labs, they're going to be sort of benchmarked on a whole bunch of like standardized benchmarks. And it really levels the playing field. So you can think about like ImageNet for computer vision, but now you see these benchmarks like everywhere. Now, why are these benchmarks kind of like important too? Is because like we don't really have much theory why these methods work, in particular, sort of like for the transformer models. For like the earlier like principal components, lots of sort of like important theory has been done. We understand the asymptotic properties pretty well. For transformers, we just don't have it. So it works, but we don't quite know like why it works, whether this is optimal in some sense and things like that. And so for that reason, we need to have like good benchmarks. Now, another sort of like way we want to think about benchmarks is that normally when we sort of like match these moments, then when you have expected returns, you would have to wait for like a very long period of time to sort of like get sort of like new data. If we want to sort of see, okay, there's new methods and we want to quickly be able to compare them, like what we try to do in the paper is to have benchmarks that are purely cross-sectional. So that means that if you just get 1/4 of new data, you can sort of like have a powerful way to screen between different methods, okay? And so then we can sort of easily compare which methods work, which subsets of stocks they work and don't work, okay? And so we have sort of like 3 sort of benchmarks currently in the paper. One is to explain valuations. Think of it as like, I want to estimate my model based on 80% of valuations, and I want to extrapolate to the other 20% that I kind of left out, and how well can I do relative valuation? Okay, it's kind of like what you would normally do with like comparable stocks. Second one is explaining co-movement, sort of like to your question about like, are you capturing correlation patterns well with these embeddings? So that's kind of like the second benchmark. And the third one is asset similarity. So that's really sort of like thinking about if I mask a subset of stock, how well is the model able to predict which stocks are missing. Okay, you can sort of extrapolate this like predicting trading and so on. Okay, and so the main takeaway from our research is that sort of these asset embeddings perform quite well on these benchmarks, similar to observed characteristics and often better. Okay. So what is the data that we're using? So in our earlier research on demand systems, we always relied on 13F data. What you would like to do for this one is to have like kind of maximum disaggregation, because you want to get down to like the 13F institutions is, let's say, Vanguard as a whole. But what you really want to understand is like how, let's say, Vanguard small cap value sort of like chooses their portfolio, or what is the Vanguard like technology ETF. And so we go down to like maximum disaggregation we can do for like hedge funds, for mutual funds, ETFs, and so on. We've done it for 13F too. It still works, but just not as well if you have like more disaggregated data, and it makes economic sense, I think. This is our sample, accounting data from Jensen, Kelly, and Patterson, so we can easily sort of like include whatever your favorite characteristics are. And then the question is going to be, and I'll show you some example of that towards the end, is like how do you interpret those embeddings? Because now I have this like long vector and I don't really know what it's capturing. And so we're going to use earnings call data to sort of like think about how you can sort of like potentially get interpretability of these like learned embeddings. Okay, why do investors put stocks together in a portfolio? Okay, so what are the competitors that we want to sort of like run these benchmarks on? So we're going to use observed characteristics. We're going to use the holdings-based embeddings, and then like when we started the project, so we reached out to like some of the AI labs and asked them like, okay, is there any things we should be aware of, like if you start estimating this based on holdings, based on your experience in training these like models based on text? And their sort of like view was that, well, these language-based embeddings actually already incorporate information about the company. So it's not just like the name of the company, but actually it contains additional information beyond plainly the name. And so they were sort of asking like, well, why didn't you sort of like just use the language embeddings and see how well those perform? And so we're going to sort of use 2 sets of embeddings, one from Koijen and one from OpenAI. And so what they do is you take like the name of the company, okay, and then you ask what is the embedding for that company, okay? And I'll show you that. Oops. Okay. So these embeddings that you get from these like language models, they kind of get it half right, half wrong. And so here you see these are the embeddings from like OpenAI. And what you see is they're going to mix sort of economic and semantic similarity. So for instance, over here, this is like Apple. And these are like the 10 companies that are closest to Apple. The closest company to Apple is Appian, which you may or may not have heard of. It's a cloud service company. And so it's somewhat related to Apple, but it seems hard to believe that this is the closest company to Apple. Now, if you go to Citigroup, you see lots of like firms that are in the financial sector, so it gets that part right. But then you also see that like pretty much all the companies start with a C or with CI. Okay, and so you get the point. So closest company to Walmart is Walgreens. And so these models get something right, something wrong, and there's clearly something that is really truly about Apple, sort of just a word, and there's something about sort of the nature of these companies. Now, can you do better by like fine-tuning these embeddings and so on? Like for sure. Okay, but this is just to say that kind of like out of the box, be aware of the fact that like it's mixing these two things, and they're just not like trained to do exactly the task that we're interested in. Okay, so again, in future research, we can sort of think about refining those. But in all of our tests, and probably for this reason, they don't do very well yet. Okay, so they will need some extra help. Okay, so let me just show you one benchmark so you get a feeling for what this looks like. So this is the test on asset similarity. So what we do is kind of like the ARC example I gave you before, is that you're going to mask some stocks in this portfolio. You try to predict what is the missing one. So if you use sort of like observed characteristics, then you can get an R squared somewhere between 15 and 20%. If you use sort of the principal components method to sort of extract embeddings, like we have a whole host of different ones, they roughly perform similar. If instead you use this like sort of simple nonlinear one word to vec, which is used for language models and literally the exact same code that people use for text, but now you give it portfolio holdings, it actually performs already quite a bit better. Okay? But sort of like to our surprise, if you sort of like compare this with the BERT model, the transformer model, that model performs like way better. So here you see that you get an R squared around 60%. In the previous slide, we had an R squared, okay, of around like 15 to 20%. You get a similar performance, actually slightly better, if you look at the investor embedding. So somehow it's easier to predict, if you look at the ownership shares of a company, like what are the missing investors, turns out to be a slightly easier task than to predict what is the missing stock in a given investor's portfolio. Okay? But in both cases, in particular for this task, which is going to be very useful if you want to think about crowded trades, think about predicting trading behavior, then sort of like these embeddings from the transformer model turn out to be quite useful. And again, just like before, it's really like sort of like the plain language code that we're using to estimate a model, but we just feed it different data. Okay. Now the last thing that two things I want to show you is first is that in a paper that we'll release soon, is that we show that these embeddings are not just useful for equity markets, which is what I showed you so far, but actually they're very useful also in fixed income markets. And in fixed income, it's actually much harder to get the substitution right because, again, like let's say a 9-10-year treasury bond is very close to each other, like a 10-year treasury bond and 10-year triple B, maybe not that sort of close. And so what we show over here is that you can sort of like get a measure of like similarity based on these embeddings. And it turns out that those are actually very useful to predict the future volatility of yields, downgrades of bonds, and even default beyond ratings and distance to default. And so what you see over here, this is like plainly based on ratings. This is on ratings and distance to default, and this is based on embeddings. You always see sort of a big lift once you add embeddings. And so what this suggests is that we kind of know that ratings are a bit sluggish, because rating agencies are slow to update their ratings. Distance to default is in part there to like remedy that. But then embeddings still contain a lot of information beyond that. And so that raises the question, could we potentially just sort of design a new rating system based on these embeddings where we sort of have a better way of measuring like risk because they do a better job at predicting all these like risk outcomes. But with the additional restriction that the number of like rating buckets is exactly the same as the current rating system. And second, that the transition probability from one rating category to another is also the same. Okay, so because obviously if you're going to say like, okay, here's a better rating system that's like really volatile, then like regulators of insurance companies and so on would not be sort of like very sort of like happy with that because they like to have something that is much more stable so it doesn't induce like excessive trading. And so we're asking the question, can you redesign the rating system with same number of buckets, same transition rates, okay, but do better at forecasting risk? And so we show that that's feasible. And so we sort of satisfied those two requirements, and you actually get big differences in the overall riskiness of, in this case, insurance companies. So we go back to our insurance company data from before, and then ask the question like, okay, how safe is an insurance company under the current sort of like regulatory, the current rating system? Now use the same sort of like regulatory capital framework, but now use our improved rating system. same number of buckets, same transition rates. And what you see is that companies, okay, that are relatively risky under the current system, okay, are actually, like some of them are actually quite safe if you measure the risk using embeddings, and vice versa, is that companies that seem relatively safe are actually quite a bit riskier under the new, if you would sort of like adopt this alternative way of measuring risk. Okay? And so this is showing you an application of like how you can use embeddings, in this case in credit markets, to better like assess like default risk, rating volatility, and yield volatility. But on top of that, you can start thinking about how you could potentially redesign the architecture of like fixed income markets using that information. Okay, obviously there's an important sort of like fixed point is that if you have lots of like capital sort of chasing these, such a system, then you need to think about the fixed point. But this is telling you that this is not like a small effect, for like the largest investor in corporate bond markets. Okay. I want to conclude, by like giving you, 2 more quick applications, of what you can do with embeddings. One is you can use it to generate portfolios. And so normally when we run sort of like replicating portfolios, then what you need to do is you run like the return of every firm or the stock returns of every firm on, let's say, inflation, and you get sort of the inflation beta, and you find your replicating portfolio. Here, if you have like some salient stocks, so this is during COVID, so these were the firms that were hit like the most during COVID. You can sort of have, let's say, 5 salient stocks, so let's say 5 AI stocks or things like that. And now you can use the model, like generate another sort of like 10, 20, 30 stocks that are similar to the 5 salient stocks that I highlighted. And so the model can be used to generate replicating portfolios without using sort of historical returns data, which may be particularly useful during episodes like COVID where you have like no historical data to go by. Okay? And so the last thing I want to show you is how you get interpretable embeddings. And so far you just have like, I don't know, a mapping from every stock to like a big vector. How do you get sort of like interpretability? And so what we do is we're going to ask the following question. So suppose that there's 10 stocks that are grouped together, that are clustered together by the model. Okay. Like, why would investors put those stocks together in a portfolio? And so the way we're going to do that is we're going to feed in the earnings calls of those 10 firms that are grouped together by the model and ask what's similar among those 10 firms that's dissimilar from all the other firms that had their earnings call during this quarter. And so you can then sort of ask about what are the common risks, what are the common growth opportunities, and so on and so forth. And that's going to give you sort of a narrative as to why stocks are grouped together. And so when we do this, and we first run it just sort of as a test case on 2019 Q4 when there was no COVID, obviously, you see that the model sort of can't really group these firms easily into sort of interpretable categories. So it sort of says like, well, some of these firms are oil companies, which obviously were hit by COVID. Some of them have like some regulatory risk like AIG and Boeing. And some have just some general like market and economic uncertainty. So you get very generic sort of like categories. Now fast forward to like 2020 Q2 when COVID hits, and now you suddenly sort of get like much more interpretable sort of like groupings with like the impact on COVID on demand and operations, financial liquidity, capital management, supply chain, operational disruptions. And so you can do a lot of these examples where you sort of like start to see clustering of firms. You can ask the model and look at like text data to see like why investors would group those stocks together, and maybe that's sort of useful to start getting sort of narratives about what may be driving demand and driving prices. Okay, so let me sort of like stop here and leave some time for questions. So main takeaway from the embeddings part is that we think that some of these like recent advances in AI and machine learning modeling could actually be very useful in the context of like finance and economics. And like one sort of like very natural source of data that we're going to put on the table beyond sort of the text data that's obviously useful, are these portfolio holdings, and sort of like those are like micro-founded based on the earlier model that I mentioned. And then you can sort of adjust these methods and think about sort of like how those are useful, and we find them to be pretty useful in at least the benchmarks that we've looked at so far.
So I have, I'm Adib. I have few questions regarding the asset embedding. So I'm assuming you are trying to refit the model every quarter in order to, right? So how do we determine like optimum K for the length of the vector?
Yeah.
How do you decide?
Right.
And
okay.
Secondly, let's say if I refit the model learn embedding every time, right? So if I try to build a portfolio of those stocks, as you were explaining that we can do like similarity.
Yeah.
But
Yep.
how can we keep track of each portfolio. So let's say if I am doing a short-term portfolio,
Yeah.
size,
Yeah.
I know first group almost more, right? But here, how can I keep track of over time?
Okay.
Which groups like?
Okay, great question. So what we've done is, what is in the paper is we just estimate everything like quarter by quarter. What we've done as well is to estimate it in like a rolling window. And what we see is that sort of like if you sort of expand the window, it doesn't sort of like help you that much. In particular, what we did is we sort of like, pre-trained the model on, let's say, the previous 10 quarters and then fine tune it on like 1 quarter. Okay. Meaning that, in the fine-tuning step, you don't sort of allow the optimizers to do sort of like to go too far from the initial parameters that you've estimated. It's going to do 2 things. One's going to give you like stability over time, in terms of like everything that's sort of interpretable. And second of all, you're going to sort of like get some improvement because you've learned from like the earlier periods. Okay. But we find that sort of the improvement is kind of like too small for the benchmarks that we're interested in over here, that we don't want to sort of like add like other variants. And if it's in the context of like the linear model, so for instance with principal components, one thing that we explored is if you estimate sort of like, call the matrix of embeddings like XT, okay? And instead of estimating XT like period by period separately, you can add like an extra sort of like rich penalty between XT and XT minus 1. Okay, and then you get the rotation right, and then you can cross-validate that parameter in the same way as you would cross-validate the depth of the embeddings. And that's how you can sort of like pick the hyperparameters. Yep. So I think so where does this come from? Is that sort of like when we wanted to move to fixed income markets, like when you think about sort of like stocks, you may think they have like relatively similar substitution patterns. Now, if we're going to go to fixed income markets, like the 9 and a 10-year bond, they need to be intuitively, they must be almost perfect substitutes. You go between sort of like different like rating buckets, like substitution drops. You go to different maturities, like substitution drops. And so what is a continuous measure of substitution? And so think about like essentially like a whole matrix of like elasticities, and a very natural way to parameterize that, which is then you could sort of microfound with like sort of the covariance matrix being sort of also parameterized by sort of the inner product of the embeddings, is that you can sort of model the cross elasticities as a function of the embeddings of like stock A and stock B. And then you would imagine that sort of like the more similar you are, okay, the higher the elasticity is and the higher the cross elasticity is. And so it's exactly sort of going at that point is that now we're imposing essentially the standard model that we always use. We have, let's say, mean variance, and the covariance model is, covariance matrix is a function of characteristics, imposes a lot of structure on like knowing all the characteristics at some level, and sort of like, having that sort of constant substitution. Here you're going to get sort of like a way to sort of like model the substitution patterns in a much more general, much more continuous way. And that is then like quite likely a much more realistic model, of the asset demand system. Thank you. Yeah. Yeah. So we did this actually in our restart paper with like Modu and Rob. So there's 2 ways. One is kind of like the hard grouping, but then like the issue you run into there is like kind of like which investors do you group together, and you have to make like fairly strong assumptions. So what we then did is to have like a rich estimator and to sort of say like, okay, take that group estimate as kind of like your shrinkage point, and let's so see how much sort of information you have in the data, where the amount of shrinkage that you apply depends on the number of stocks that you hold. Okay, so if you have enough data to sort of like fit the model of a particular investor on its own without any sort of like shrinkage, then that's fine. But if you have like an investor that holds a smaller number of like stocks, then you shrink it to that like same target that we had in our 2019 paper. So that's one way to do it. Now, if you combine it again sort of with the embeddings, now we have sort of investor embedding. So now I have a much better way of thinking about, okay, these investors are really similar to you. And so if they hold similar portfolios, similar tilts, and maybe trade, even if you're going to sort of bring in the dynamics, sort of like they trade similarly over time, those may have similar elasticities. Let's group those together, and that's your relevant shrinkage target. So I'm not sure about that one. I do think though that like we recently sort of, like one of the things we're doing is to sort of like build a much broader data set of like actual investment mandates of investors. So not like in the earlier, like for those of you who know, like in the 2019 paper, we kind of like made an assumption on what your investment mandate is. For a lot of investors, like there's actually sort of explicit information that, of course, for mutual funds and ETFs, but actually for many more investors, that information is available. So we're collecting all that information. So you would actually get a much better like direct measure of like what it is. And I think with the growing importance in particular, because in the early paper, we went back to 1980, which was much harder because you didn't have that information. For like the recent period, there's a much larger fraction of market cap has these sort of like explicit mandates, and then I think you can build a better version of that, sort of like same economic logic for the instrument. So I'm not sure whether machine learning is going to be useful for that, but I think there's better sort of institutional data we can use now. Thank you. Yeah. Oh, you mean like using the additional institutional data? Oh, no, I think it's an improvement, yeah. Because before, like, think of it as like, if I would know for sure that this is your investment mandate, that would always be better than us trying to back it out using the previous, like, 11 quarters. Now, there may still be some additional sort of, like, information you get from the previous 11 quarters because, like, maybe there's just, like, some specialization that you have, and that's what you would learn from the previous 11 quarters. But our thinking at this point is that by collecting lots of data on, like, explicit mandates, and benchmarks you're compared to, we're going to bring in, like, lots of additional information on what your actual mandate is. And that we think is going to be sort of like easier to sort of like identify those like strict boundaries than using the previous 11 quarters. We'll talk there. Yeah, thank you.